Hi, everyone. My name is Lisa Mahoney, and thank you for joining me because we're going to talk about insurance considerations. So, insurance can be really confusing. The terms are really hard to understand, and we're going to talk through all of those things so that eventually you can determine what is best for you and your family. And ultimately, I want to educate, empower, and encourage you to make the best decisions possible. This presentation, live streamed, or on demand, is for educational purposes only and does not constitute financial, legal, or tax advice. The concepts and strategies shared are intended to inform and empower, but may not be suitable for your specific circumstances. Consult with a team of qualified financial professionals, including but not limited to registered investment advisors, accredited financial counselors, tax professionals, and attorneys who can provide personalized advice tailored to your unique needs. Any references to specific companies, products, or services are for illustrative purposes only and do not constitute endorsements. Investment involves risk, and examples presented are not a warranty of results. By participating in or viewing this content, you agree to assume full responsibility for your financial decisions and outcomes based on the information provided. Ultimately, everything that I'm going to discuss is all about you. I really want you to have a better understanding of insurance and terminology. We're going to talk about how to lower your premiums and even use tax favored options. We'll also talk about the No Surprises Act. Some of you might be in the military, and DoD statistics show that 81% of service members exit with fewer than 20 years of service. So even for my military members who may be thinking they're going to go 20 years or more, that may not be the case for you. So you're welcome to watch this video and learn more. And contractors can also check with their insurance options that they have with their employer. Hopefully, all of this will make sense to you. So ultimately, when you learn as much as you can, you will make better and informed choices. So I would start with consulting with some professionals. So you'll want to get some information from your HR or benefits office, and you'll want to get some advice maybe from some other folks like tax advisors, registered investment advisors, and even estate planners if you're looking at the big picture of your finances overall. You can look for insurance brokers as well who can help you identify affordable insurance options. It depends on the type of insurance that you're looking for. And you'll want to also take a look at what your needs are for yourself and your loved ones. So do an overall assessment. What are your current circumstances? What is coming up in the next benefits year that you may need? Will it be surgery? Will it be dental? What is your current coverage, and is it sufficient for what's going to happen that you know of, or do you need to make a change? And then, of course, all of this factors into your finances. This will lead you to make better and informed decisions by doing the research now and talking with some folks. This can take maybe an hour or 2 hours at the most for you to get ahead of this coming benefits year. We are going to talk about the different types of insurance and basic terminology. We'll talk about some traditional and non-traditional insurance plans that you may have experience with, as well as some tax-favored saving strategies. You may be able to save as much as 50% on your premiums, and we'll talk about what that looks like. And we'll also talk about the No Surprises Act that went into effect a few years ago. And we'll talk about where you can find some additional resources and other considerations to make. We are going to talk about the role of insurance, the types of insurance that you may need to protect your finances, and how to increase financial security overall. And this is the journey that you start to determine what do you have, what do you still need, and what can you cancel. The role of insurance is to transfer risk from you as the consumer to the insurance company that you have a contract with, that you're paying premiums to. The idea is that it protects you from catastrophic expenses. Now, I've listed 9 types of insurance here. You may need more, you may need less, depending on your circumstances. I'm not going to go over these 9 types in great detail. And the reason why is because there is another video that's available called Insurance, What You Need and What You Don't. Now, the first icon, because I want to make sure you understand what these icons represent, the first icon is for health insurance. Now, that's the purpose of this video. We're going to do a deep exploration of that today. There's also auto insurance as well as homeowners or renters insurance. An umbrella policy can be added to auto and homeowners to extend the liability coverage that you have, and it's very inexpensive to do that. There's also identity theft protection and restoration service, as well as long-term care insurance, term life insurance, long-term disability insurance, and professional liability insurance. Now, as you're looking for these different types of insurance, depending on what they are, you may want to compare costs and needs. And in some cases, such as with auto insurance, you may want to use an insurance broker. And you'll learn more about that in the video called Insurance, What You Need and What You Don't. Health is not valued until sickness comes. Now, Thomas Fuller said that some folks consider dropping health insurance because of how much it costs per paycheck or per month. And one health emergency can set you back. What we know is that medical debt is the #1 cause of bankruptcy in the US. And that's even if you have health insurance. So please make sure that you can find a policy that will help you in the coming year and then reassess it every year. Okay, I'm glad you're still with me. Every year, 93% of Americans keep the same insurance. And more than half, 60% of Americans don't have the best plan that meets their needs. So, as I mentioned before, it takes about an hour or 2 at the most to look at the options that are coming for this year, read the health plan brochures, and assess what you need. I am going to focus on health insurance and commonly used terminology, and then I will discuss 3 types of health insurance plans. Okay, I'm glad you're still with me because now we're going to talk about health insurance terminology. I was on a Facebook group and someone was asking about the terms because they didn't understand what they were, and they're confusing. These are industry terms, if you will, that we have to become educated on to understand where our money is going. So let's talk about these. Depending on how you acquired your health insurance, it may have been on the marketplace or it may have been through an employer. If you acquired health insurance through your employer is going to be paying the majority of the premium cost. And so that could be around 72%. The premium is the amount that you're paying for coverage through payroll deduction. So when you look at your pay stub, you'll see that a certain amount is coming out every paycheck. So for example, $7,100 for a family of 4 could be about $273 coming out every 2 weeks. The copay is a flat rate that you're going to pay for services for every visit. Now, it could be a prescription. It could be a lab where you're getting blood drawn or something else done, a visit to your doctor, maybe a hospital stay. When you look in the health plan brochure, it will specify how much you're going to pay. That's the copay. And then there's also the deductible. The deductible is the minimum amount that you're going to pay before the plan covers a large portion. So let's say it's $500 if it's just you, yourself, who's being insured. Once you've paid that $500, then the insurance will start to kick in and cover the rest. And usually that is defined through the co-insurance. Co-insurance is very different. It's the cost for service that you are sharing between yourself and the insurance company, and it's expressed as a percentage. So, for example, Medicare recipients, they pay for 20% and Medicare pays for 80%. Now, when you have your health insurance plan brochure, you can see what is the co-insurance amount, what percentage is that. And then finally, there's an out-of-pocket maximum that your health insurance will keep track of as you are going to visits and getting other things done. They're keeping track of how much you're paying throughout the year. That is the maximum dollar amount that you're going to spend before insurance covers the rest. Now, it's going to be thousands of dollars typically. And for a plus one or plus family, it could be tens of thousands of dollars. So just be aware of that. Keep in mind that there are going to be your premiums, co-pays, and other things contributing to that out-of-pocket maximum. But once you've reached that, then the insurance takes over completely. So that way you're not completely out of pocket. I have to admit there are several types of health insurance networks and coverage, and I'm only going to focus on these three types because they're the most popular. They tend to have the best, I guess, financial options and opportunities that are available to you. So the first one is called a preferred provider organization or a non-preferred provider organization. We'll talk about what that means. The second one is a health maintenance organization. And the last one is a high deductible health plan. We're going to talk about how different plans work. One of the most common types of plans that employees select are the fee-for-service plans. Blue Cross Blue Shield is a major example of this type of plan, and I've used them myself. If you stay in network, meaning you're using a preferred provider organization with whom Blue Cross Blue Shield has an agreement, that means you're going to pay less out of pocket. If you use a healthcare facility or provider out of network, it will still be covered, but you will pay more out of pocket. Sometimes certain providers, such as anesthesiologists, may be out of network and you have no control over that. Even if the facility is in network, you may end up paying higher costs when this happens, but we'll talk about an exception to that on a future slide. But it's important to understand that overall, when you stay in network, when you're going to someone who's on the preferred list with the insurance company, you're going to pay less. When you go to someone who's not on that preferred list, you're going to pay more. The second type is a health maintenance organization. So what that means is that care is coordinated across different types of providers, from your general practitioner to radiology and orthopedist to physical therapists. This is because they are in a geographic network under the same brand. And a great example of this is Kaiser Permanente. I was a regular patient with them for several years until I eventually moved overseas. One other thing to point out is I do have some folks who are either service members or federal employees who may end up going overseas. Usually the service members, they're taken care of, right, on an installation. But for my civilian federal employees, if you have an HMO and let's say it's Kaiser Permanente and you are planning to live and work overseas, you will need to change your health insurance coverage to a different type of plan. And that's because HMOs do not work overseas, and I don't want you to be out of pocket thousands of dollars while you're away. So be sure to take care of that and change your election during either open season or when you're planning to PCS. The third type of coverage I'm going to discuss is a high deductible health plan. Now, these are great if you are looking to lower your premium costs for health insurance. Right now, I have a high deductible health plan with GEHA. As with other providers, they also cover 100% of healthcare costs when you've met your deductible and out-of-pocket maximum. The difference with GEHA is that they will consider them at the in-network rate if you're living and working overseas, meaning you will pay 5% instead of the 25% for out-of-network costs. Now, with a high deductible health plan, there are higher cost sharing expenses, and that means that you are going to be paying more out of pocket. So make sure you are financially healthy if you're going to adopt this option. The nice thing about the high deductible health plan is that it comes with a health savings account, and we are going to discuss more about that. Okay, there are several tax favored savings vehicles. And I'm going to discuss both healthcare and caregiving expenses or parenting expenses. There are rules and eligibility requirements. You can use some, but not all of them together, and we're going to take a look at those right now. Before we get into the health tax favored savings, I do want to cover the dependent care flexible spending account. Anyone can elect to fund and use an FSA. You would determine the annual amount, and payroll calculates and deducts it as a biweekly amount. Now, the dependent care FSA has finally increased after years and years and years of being at $5,000 just for the year to $7,500 for 2026. So this applies to dependent care expenses for children 12 and under, adult care for those whom you claim as a dependent on your income taxes, and some examples of qualified expenses might be preschool, summer day camp, before and after school programs, child or adult daycare, babysitting, but not on date night, babysitting if it's work related, meaning it's during the workday or while you are finding work. And this also includes nanny and au pair expenses. And perhaps you're caring for a spouse or relative who's physically or mentally incapable of self care and lives in your home. Let's talk about the healthcare flexible spending account, right? So during open season, you will determine how much you want to set aside for your healthcare expenses that are coming up in the next year. You determine the amount, payroll calculates and deducts it on a biweekly amount or how often you get paid. Now, you can set aside as much as $3,400 for the upcoming year as a household. And keep in mind, you can use the healthcare FSA in addition to the dependent care FSA. This is pre-tax dollars coming out of your paycheck. With the FSA, you can claim the full amount from the very beginning. The FSA is use or lose, meaning you have a certain time frame to use all of this up. Some employers will allow you to go into the next year, usually March 15th, in order to get all of your expenses claimed. You do lose it when you separate from your employer. Typically, you use the healthcare FSA with a PPO or with an HMO. There is a different type of healthcare FSA, and depending on who your employer is and what HR says, it'll either be called limited expense FSA or limited purpose FSA. The amount that you can have put into the FSA is still $3,400, and in this case, it applies to dental and vision expenses only, and there's a reason for that. So you can still have an FSA, and it would be used for qualified dental and vision services and expenses only. But this is what you would use in combination with a high deductible health plan. I just mentioned that if you decide to have a high deductible health plan, you can have a limited expense or limited purpose FSA for qualified visual and dental services and products only. You can then combine that with this, which is a health savings account. Okay, these have different limits or contribution limits, I should say. So 4,400 if you are insured as self. If you're insured as plus one or family, the maximum contribution limit is 8,750. Now, if you are age 55 and older, you can contribute an extra $1,000. And again, that can be pre-tax dollars going in. This is a unique product, if you will, because what it means is that it's a bank account. It's not something that payroll will set up for you. You will need to go into payroll because when you sign up for your high deductible health plan, you're going to receive a debit card as well as the banking information. And so you'll go into payroll, you put in the banking information, and you'll say, I want to set aside so much per paycheck to go into this. Now, you'll need to be careful. Some employers will actually partially fund or partially contribute to the HSA. So you do not want to exceed the combined contribution limit. And so this is a really great opportunity. This is not use or lose because it's a bank account, right? You can keep all your receipts, you can claim them at any time later. This bank account is yours when you change jobs or plans. It is triple tax benefit. You can contribute tax-free. It'll grow tax-free. And when used for qualified expenses, you can withdraw tax-free. And there's also an option to invest a large portion of your HSA to grow over time. And we'll talk about that on a future slide. There is also an opportunity to pay for long-term care insurance premiums, and that is an age-based cap. So please check out IRS Publication 502 for more information. One thing I would like to highlight is that as you're getting closer to Medicare age, which is the age of 65, about 6 months before, you will need to stop contributing to your HSA. There's a 6-month look-back period when you enroll in Medicare, and HSAs are not compatible with Medicare. Let me be clear. HSA contributions 6 months leading up to enrolling in Medicare are not compatible. You may still use your HSA for qualified expenses if you wish. You can let it grow over time, but this is a great way to save tens or hundreds of thousands of dollars depending on how soon you get started and what how you apply this. Now, I do want to note that in the upper left-hand corner, if you need help navigating Medicare, you can get trusted, unbiased, local one-on-one Medicare counseling and assistance for free. This is funded through the government. This is not the Medicare Advantage commercials that you see usually starting around September, October, November, okay? So shiphelp.org, find your state, click on that, get the one-on-one Medicare counseling and assistance. This is education to help you choose the best Medicare plan for you. So this is something that's a little bit different. This is an HRA or health reimbursement arrangement. It's going to vary by plan based on what the HSA was supposed to be for that plan. So the HRA gets opened by the high deductible health plan when any of the following conditions exist. So if you're eligible for or enrolled in Medicare, if you have not received VA except for service-connected disability, or Indian Health Services benefits within the last 3 months. If you are covered by another non-high deductible health insurance plan, meaning if you're covered by, let's say, Blue Cross Blue Shield or Kaiser Permanente, you cannot have an HSA. They will open an HRA for you. If you're covered by your spouse's healthcare flexible spending account, you can't have an HSA. They will open an HRA for you. If you are a dependent on someone else's tax return, same thing, they'll open an HRA. With the HRA, you will not be able to make deposits. Of course, there's a ceiling limit according to what the high deductible health plan says. The HRA does not earn interest because you don't own the account, and it's not transferable when you leave the plan or service. But it may roll over year after year, and we'll talk about that on the next slide. So we have a table here in order to make it easier to compare the HSA, the HRA, the FSA. As you can see, both the HSA and HRA have tax-free withdrawals for qualified health expenses, and the unused money rolls over from year to year. The HSA funds are yours to save and invest and grow year after year. It's portable and goes with you when you leave employment or change plans. The HRA is owned by the employer and continues to roll over. You don't get to take the remaining funds with you if you change plans or separate from service. So that is something that you should be aware of, just to give you a better idea of what this looks like. And you're welcome to pause the video if you need more time to look at this chart. From a financial standpoint, you have larger purchasing power from your health savings account. Now, this is a comparison of the purchasing power at age 65 of $4,000 in annual contributions beginning at age 45 of an investment return of 5%. So this is 20 years of growth, okay? The thing is that when you put money into a 401k or let's say an IRA, then there is no penalty after age 59 and a half, but you will pay taxes on the withdrawal, okay? Now, when you have a Roth, there are no taxes because you paid the taxes up front. So that's why there's a little bit more of a tax benefit. But when you have an HSA, there are no taxes from the very beginning, right? This was pre-tax dollars that went in. It continued to grow tax-free, and because you're using the HSA for qualified expenses, it remains tax-free. So there's additional purchasing power when you have an HSA. So remember I discussed how HSAs are yours to keep when you leave employment or change plans, and you get to decide how to use your money in the HSA. Okay, now depending on the employer, not everybody does this, but some employers allow money to pass through automatically from your premiums into the HSA. It's called a premium pass-through. And what that means is that money automatically gets deposited each month at no cost to you. And in this scenario, we're going to talk about, you'll see how much that is, okay? And you get to decide what to do with this money. You can use it, leave it, or invest it. So here's some examples. Alex is a single household who receives enough contributions each month that totals $1,000 a year. And Alex uses that balance for qualified health expenses, and that leaves nothing in the HSA. And that's what it's there for, okay? If you had an FSA, that's pretty much how you use it. Now, Blake, on the other hand, decides to save and invest that $1,000 a year without making any additional contributions. Now, keep in mind that Blake is investing this over 25 years, and let's say Blake puts this in the S&P 500. Now, we know the S&P 500's average is 10.2% over the last 25 years. Now, what you're seeing here is not a warranty of future results, and this information is for educational purposes. Investing risk, costs, and losses are your responsibility, okay? But this is an example of what can happen when you invest in the S&P 500. And in this case, Blake has well over $100,000 after 25 years of growth. Now, in this third scenario, what we see is that Charlie is investing $1,000 annually and is also matching that $1,000 of premium pass-through uh, as well. So $2,000 is being invested annually into the S&P 500 for 25 years. And based on that, what we see is over $201,000 after investing for 25 years in the S&P 500. Now, when we look at Drew decides to not only invest the $1,000 annually, but also contributes each year the maximum amount. So this would be $3,400 to make up that combined contribution limit of $4,400. Now, by maxing it out every year for 25 years and investing in the S&P 500, what we see is that there is well over $500,000 in the HSA. Okay, let's talk about some additional factors to consider when selecting the best insurance plan for you and your family. In addition, you need the right plan if you work and live overseas, as I mentioned before. Okay, so see, these are some of the additional factors to consider. The first one is when you look at the health plan brochure, consider your family size and what the rates are. So if you are a plus one, if you're a dual household, okay, dual households can either sign up for plus one or plus family. And depending on the health plan brochure and the insurance plan, I've actually seen where the plus one is higher than the plus family. So take a look at that, all right? Do the math. And you can be a plus family as another dependent, if you will, on the health insurance plan. Um, Also take a look at the health plan brochure and determine if there is dental or vision coverage and what type may be included. Now, normally in health plan brochures, what you will see is that it'll cover like catastrophic incidents, like, oh, there has to be some oral surgery because there was an accident. That's not what I'm referring to. You want to make sure that these plans include maybe some sort of dental or vision annual visits that they will cover, because some of them do that. And so why would you then need to go out and get independent dental or vision covered when it's already covered in the health insurance plan that you've selected? Another factor to consider is what kind of specialists do you need? What are their costs? And are they included in your plan? Okay, so perhaps there's going to be another addition to the family. Perhaps you know you're going to have knee surgery or something else that's going to come up in the new year. You might want to take a look and see what are those costs going to be. Is surgery included? What is the copay? Is there a copay? What does that look like? As I mentioned, you also want to make sure that the people that you like to see and that you want to continue seeing are still accepted in your plan. So you can talk with your medical professional personally or their staff and see will they accept your health insurance plan if you're switching, or will there be any changes that may cause you to think that you may want to switch. I'll give you an example. This year, United Healthcare had a falling out, if you will, with Johns Hopkins. And so most of the Johns Hopkins facilities and their providers are no longer have an agreement with United Healthcare. So for that reason, if you have specific specialists that you want to see, or there's continuing care that you have some options. You can get a 90-day letter because you were pre-authorized and you still get care, but you have to renew that 90-day letter. Or you can switch into a plan that works with Johns Hopkins, and that way you know that you have that insurance coverage. Something else to consider are your prescriptions. What types of prescriptions do you have? What kind of coverage will they provide? What are the costs going to be? Is 90-day mail order an option, especially when you're living overseas? Um, Perhaps you want to go to a prescription discount program, such as GoodRx or Optum Perks or Simple RX. There are all these different prescription discount programs that you can use instead of your health insurance. And so that is another option that you can do. And then sometimes manufacturers themselves offer discounts, right? And that in turn may be cheaper than what your health insurance may offer. Now, if you're concerned about your prescriptions, depending on your HR resource and benefit, you may have the option of looking them up directly at the health insurance plan's website, where you can put in the name of your prescription and the amount and how often you get it filled. And it will tell you directly how much that will cost, especially if it's a new health insurance provider. The other thing that you can look at is your healthcare costs from previous years. And you may be spending an average amount if you don't have any dire situations. So one of the things that you can look at is you can log into your health insurance network, and they may have a tally of how much you have paid out in the previous year. The other thing that I really want you to consider is your finances. As I mentioned before, there are going to be some situations where you may want to choose one plan or one type of plan over another. So, for example, if you are living paycheck to paycheck and you do not have a 3-month or 6-month emergency fund of basic necessities, I don't want you to sign up for a high deductible health plan. The reason for that is you're going to be responsible for paying thousands of dollars out of pocket initially as part of your deductible, because it's a high deductible. And if you're living paycheck to paycheck, that's not setting you up for success. If you don't have that emergency fund yet, go with a PPO or an HMO. Okay, everything is built in, you know it's being deducted from your paycheck. You'll generally have a low deductible or no deductible depending on the plan that you choose. Now, if you have a 3 to 6 month emergency fund, then I'm going to say yes, you should get a high deductible health plan, and that will serve as an additional fund for healthcare expenses that will roll over year to year. And remember, HMOs do not work overseas. Okay, so one of the things I had mentioned previously is that we have no control over who our anesthesiologist will be, or sometimes if a lab provider or even a facility is in network, depending on the situation. And that in the past, that has caused a lot of problems for Americans. And I mentioned previously that medical debt is the #1 cause of bankruptcy in the US. So in order to deal with being charged by out-of-network providers such as anesthesiologist, radiologist, surgical assistant, so on and so forth, there is legislation that came out called the No Surprises Act. Okay, and what this means is that there will be no more surprise medical bills from most private and public health insurance plans for out-of-network costs. And so these provisions include emergency services, regardless of location and who that medical professional is, and they'll be treated as in-network. And ancillary out-of-network care, such as an anesthesiologist at an in-network facility, will also be charged as in-network. What it also means is that your costs as a patient for copays, coinsurance, or deductibles for emergency and non-emergency services won't exceed and must count toward your in-network limits. Okay, so no more balance billing, no more balance billing. There is an exception. Okay, so what that means is if you are notified in advance in writing and you provide written consent, meaning a signature, you will be charged out of network. So please pay attention to your intake paperwork. Read it and make sure that you are not agreeing to being charged for out of network services. Now, you may end up being charged for out of network services. And when that happens, I have this link here to the state consumer assistance programs. Okay. And so you should be able to speak with your state's consumer assistance program, who will help advocate for you on your behalf and deal with the balance billing issues that you may receive. Okay. If you work in the private sector, nonprofit, make sure you're working with your HR to find out what your health plan options are and read the health plan brochures. If you are a federal employee, you can go to opm.gov/FEHB compare to compare up to 3 types of insurance plans side by side. If you want to see the premiums, if they haven't been posted in the FEHB compare site, you can go to opm.gov/FEHB premiums. Again, we have gone through a lot and now you're more informed and now you know what to look for. Okay, if you are in the market for health insurance, you have a limited window during open enrollment to either enroll, disenroll, or to change your health insurance plan. The tools on the left are for federal employees. Now, if you are in the private sector, perhaps you're in state or local government or in the nonprofit arena, you'll need to work through your HR benefits office. Now, for federal employees, these are the links that you can use to compare insurance plans, check their costs, and enroll in dental and vision as needed. Now, if you choose a traditional insurance plan, such as a PPO or perhaps an HMO, you may want to enroll in an FSA Feds plan as well. If you decide that you want to do a high deductible health plan, you still go through your HR designated benefits sign up enrollment process, okay? And you would opt into select that high deductible health plan that you want. When you do that, the high deductible health plan insurance company will automatically work with a bank with whom they have an agreement to open that HSA in your name, and they will send a letter with your banking information and a debit card. That is how you get your HSA. Once you receive your HSA information, go back into your payroll system and add the banking account information as a separate deposit. Decide how much you can afford to contribute each paycheck. That is how you enroll in that. Now, if you're going to do the HSA, you can do the limited expense or limited purpose FSA for dental and vision only, but be mindful of what those expenses could be. Are you getting dentures or implants? Maybe you want to contribute more. Is it just routine vision and dental? Then maybe you want to contribute less. Remember, FSA is use or lose. You can always supplement those expenses with your HSA. Please take advantage of your health plan brochures. Please talk with your HR or benefits office. On the right-hand side of the screen, you can enroll at any time into long-term care insurance, term life insurance, identity theft protection, and professional liability insurance. It can be really hard to determine how much your expenses are for your health, and health insurance plans are only one factor. To help you compare different health insurance plans and their rates, I developed this Excel calculator that you're welcome to download and use for free. You can find it at tinyurl.com/talk-money-material, and it's in a folder for calculators. Thank you again for watching this video. I really appreciate your joining me, and I hope you learned a little bit more about insurance. If you would like to download some free tools and resources, you're welcome to find them at tinyurl.com/talk-money-material. It's a Google Drive I set up, and they're in different folders according to topic. Also, you're welcome to like and subscribe this video. If you want to subscribe to at Talk Money Sense, that would be great. You'll be notified of any new videos that I post. And thanks so much for watching.